So we're very excited to see everybody here. Welcome this evening. I figured we'd start with a story. There was a young boy, and he was invited to go visit with his grandmother. And so the grandmother said, okay, Johnny, let me give you directions. When you come to my building, I want you to take your right elbow and push the button by 3A, and then use your left foot, and that's gonna hook open the door. Then when you get into the hallway, take your right elbow, push the buzzer, and then with your right foot, you'll be able to hold open the hallway door and ask somebody to push the button on the elevator, and I'll meet you on the 3rd floor. He says, Grandma, I'm excited to see you, but what's with the left elbow, the right elbow, the left foot? Like, what's all that about? And she pauses for a second and she says, you're not coming empty-handed, are you? It takes a minute. It takes a minute. There you go. It's corny, but the point is that nobody will be leaving here empty-handed. Usually this time is reserved by the NIBA board to provide a timely topic that they feel can provide each and every person here with some sort of value add to meet whatever that objective is, whether you're a private company or a public company. And this year there was no one particular topic that stood out. In the past, it was DTC eligibility, it was deposits, it was different methodologies of how to go public, and so this year we all decided that we would do a general Q&A panel with a phenomenal panel of experts in a variety of different fields. And so to kick it off, I'd like to ask each and every person to just do a quick introduction about who they are, a little bit of their expertise, what firm they're at, and then we will open up the floor to general questions.
Hello again, everyone. Andrea Cataneo. I sit on the board of NIBA, and I am a partner with the law firm of SheppardMullin, Richter, and Hampton. We call ourselves SheppardMullin for short. An AmLaw 100 firm that is 95 years old. I've been there for 3.5 years, but I do what I do. I've been doing this for 24 years. I consider myself to be a private and public company capital markets expert, if you will, only because I've been helping companies get financed for most of my securities legal career, and much of what I do is matchmaking. Sitting on the board of NIBA enables me to do a lot of that for my clients, and that's what gives me lots of joy. So allow me to pass the microphone to my esteemed panelists.
Hi, everyone. I'm John Uretsky, and what I guess I like to consider myself is a litigator to the small and micro cap markets. It's a bad word, it's a scary word, I know, but in my experience, let's say in the past 20 years, small and micro cap companies do have litigation needs. They do get sued, they need to sue other people, they do have problems with regulators. And it isn't the same solution that you would have if you were representing an investment bank like Goldman Sachs or a company like Google. They have more in financial wherewithal, and we have generally tried to work with those types of companies for the past 20 years. For the past 15 at a very small firm called Phillipson and Uretsky, and my last name is Uretsky. You can see how small we are. You want somebody bigger, you definitely should go to Andrea.
It made me think and add my years up, and unfortunately, been in the business for 30 years now, so just I think it was in 1989. It started with E.F. Hutton, if anybody's ever heard of E.F. Hutton, so that really dates me. Anyway, I've been in the business for 30 years, branch manager, syndicate manager, head of investment banking, various other positions. I am currently the principal of banking and syndicate for Dawson James out of Boca Raton, Florida. We have offices in New York. Boca Raton is our headquarters, and in Columbia, Maryland. With that, I'll pass it on.
My name is Jonathan Keim. I'm the Director of Communications for NetworkNewsWire, and that's just one brand out of 40, part of the Investor Brand Network. We mainly focus on article syndication using social media and other channels to get information out to investors that may not have heard of a particular company before.
Great. And last but not least, my name is Seth Farbman. I'm the chairman of VStock Transfer. We're a full-service stock transfer firm. We service about 700 public companies, and chairman of VCheck Global. And we're a full-service corporate background check and due diligence firm. So a lot of what we do, not necessarily matchmaking, but working with companies through various parts of the going public process, getting listed on various exchanges, and as well as working with them to enable them and their shareholders to go through the application processes to get listed. And so we've got a variety of different backgrounds at your disposal this evening. And so let's open up the floor to see if we have any questions, both on the private or public side, and no holds barred. And I said that there would either be a lot of questions or crickets. Prove me wrong. Jim Hock.
What are some different ways to go public? What a nice question.
Layup. Andrea Cataneo.
That's compliance.
So there are several ways that a company can go public, and it's not just the IPO. I've written about the organic going public transaction many times over the years because that's something I'm a proponent of. But before I kind of go into the process briefly, because I don't want to give you too long an answer, I just want you to realize that it's something that can be achieved by yourselves as companies, as small business issuers, without an expensive IPO and without a reverse merger, which is another mechanism to go public, merging your private entity into a public company, whether it's a shell, meaning it has no business operations, or it has business operations and reports to the SEC, the Securities and Exchange Commission. Some investors prefer a company that's public because a company that's public is forced to be transparent. A public company has to have audited financial statements, and that gives investors a level of comfort to a degree. It also gives them an understanding that officers and directors have to meet certain criteria and can't have had issues because they would be rejected for trading purposes. So many, many advantages. I won't cover that long list, but the going public paths could be IPO, which could be costly, and it is reserved, I think, for companies that are either pre-revenue biotechs that have a huge potential upside or extraordinarily profitable revenue-generating companies that have proved their model and have an underwriter that will back them to do the IPO. The other two methods that I'm happy to discuss with any of you in more detail, the reverse merger process, which can be complex, can be simple, but it basically entails, like I said, merging the private entity with an entity that's already public and then combining financial statements, getting them audited, and becoming a reporting company to the Securities and Exchange Commission, or my favorite, the organic method. And I'll just spend 2 minutes on that, and then I'll see if anyone else has anything to add. But I think what a lot of companies don't realize, even if they have a relatively simple cap table where they only have 2 shareholders, let's say themselves and maybe a family member or a synergistic company that is helping them and they want to raise money. As a securities lawyer, I'm going to take a look at things like the company's certificate of incorporation or articles of incorporation, depending on what state they're incorporated in, and make sure they have enough shares to grow their company, enough common stock shares. But bringing in investors and raising capital in a manner that makes you eligible to go public needs a little forethought. And you need to have at least 50 shareholders to trade a stock. So, keeping that in mind, if you're dealing with some experts, and believe me, you'll meet today, tomorrow, and you've probably already met and have on staff or as part of your bevy of consultants, people who can advise you in this regard. But having a plan in mind to build a shareholder base, which may take 1 or 2 stages to build that shareholder base of offerings that follow the securities rules and the exemptions from registration, et cetera, and filing then a registration statement with the Securities and Exchange Commission. I don't want to get too technical, but the steps are raise money, build a shareholder base, file a registration statement with the Securities and Exchange Commission with audited financial statements, and then find a market maker and get trading. And these are things that people who have been doing this for a long time can walk you through, and in 6 months' time, a private company can build this whole process and have a public company without merging into someone else's company that might have liabilities or litigation or skeletons. And an IPO, you've heard rumors of how expensive that might be. If it's not for you, but you want to go public, there's a path to take, and I'm happy to go into more detail with any of you who have interest.
So there are a lot of different options depending on the size of the company or depending on the objective. But I think one of the beautiful things about NIBA is that almost everybody here is in a different sector. There are all different type size companies here. So I guess maybe Carlo, if you could shed some light, what type of company, what type of deals are getting done in this environment? I mean, we've seen a lot of IPOs that are extremely hot and then drop quickly, and there's been a lot of buzz about them, and then it's quieted down. But over the last, say, 6 to 9 months, what have you seen actually get done?
First, I want to jump on her question here.
I knew you would.
No, that's the first thing I always ask. Why do you want to be public? It's amazing the answers you get. I want to get rich, which is always the wrong answer, of course. There's a lot of times practices or companies, they don't have children, they want to hand their business down. They want their employees to participate. They want their community to participate. Usually the answer really comes down to it's cheaper capital if you're going to be a public company. But we see a lot of the Chinese companies going public, and you always scratch your head because for the most part, nobody's made a whole lot of money on Chinese companies going public. And believe me, the Chinese guys, the investors over there put a lot of money in these companies. But the main reason why they do it is transparency. As she said, that the fact is they are bidding for contracts with the government. They're dealing with various other entities in China or in the United States or around the world. And the best way to present yourself is in a transparent way, so they'll know who the management is, what their history is, what the financials are, and by doing that, becoming a public company opens their business up to a lot of avenues that they wouldn't have if they were a private company. To get to Seth, your question is, it's not like it used to be. You can't write an idea on a napkin. Even in the public sector, I say, you can't write an idea on a napkin and go raise money, go to a bunch of bankers. We hear every day, hey, we got a company who wants to go public. We listen to it, and it's like, hey, you should try that yourself. You don't have any customers yet. It's an idea still. The only ones that's really going to get done is those that have not only a plan, but have started to execute their plan. They have some revenues, have a management staff, have a business plan, have a distribution plan for their product. It's gone down the ways. These days, there's either private, or you're a NASDAQ for the most part. The OTC is a whole other topic to talk about, but that's a tough market to be on right now. So, if you're caught in the quagmire, you really want to spend your time building your business. And once you build your business, those are the companies we want to fund. Those are the companies that are fundable these days.
So a few years ago, I saw an amazing movie called La La Land. And sometimes when you see some of these companies ringing the bell and they're at NASDAQ and the confetti is flowing, it seems that way. But trust me, from where I sit as a transfer agent and where the CEO sits and some of the shareholders sit, it's not always La La Land. And litigation is definitely an important component of that. We've got 2 Jonathans up here, so I'm going to refer to you as Jonathan Esquire, if that's okay.
Or John.
Or John. What are some of the, I guess, the bullets that companies that are raising capital, both at the early stage as well as a publicly traded company, really should be aware of to try to avoid the potential pitfalls of litigation, or once they're in it, things to be leery of to try to get out of it as quickly as possible? I know that's a broad question, but...
No,
some
because
takeaways.
It's really, I think, I mean, litigation, it's not like rocket science, like Jim had said, and a lot of this, I think it's pretty easy. I think, well, actually, let me, if I may, just by a show of hands, who here knows who Don Larson is? I'm sure some of you remember Don Larson, Game 2 of the World Series, right? Somebody tell me what happened in Game 2. You're all wrong. Game 2, he lasted 1 2/3 innings. He got removed. The Yankees lost 13-8, and no one remembers that. Why? The reason no one remembers that is because, yeah, he did a little bit better in Game 5, as you may have heard. That was the perfect game. My point is, no one remembers him for his loss. Everybody remembers him for his win, and that is what you should be striving for with your litigation reputation. When the SEC is going to look at your deal, they're going to wonder, all right, am I approving this or not? Is it a bad company or is it a good company? And it really shouldn't be that basic. But if they know that you're safe, you're good, you're perfect, then honestly, those skeletons don't even get looked at. You get your approval. It goes a lot quicker. You don't need them to massage the things that they're otherwise going to need to massage for you. On the other hand, if you get known for that big loss, even if you do later on do pretty well, you're going to have a lot of trouble getting approved. Maybe your deal gets done, but you know what? First they ask a question, then another question. Why? Because of those skeletons. Now, how can you make the bad things go away? It's actually pretty simple. You're going to get good advice, and if you have good, you have to spend the money on the D&O coverage in the first place. Insurance can make these problems go away. You have someone identify it before it becomes a litigation. And if you just have some advisor say, you know what, this looks pretty bad. Why don't we get this settled before they file? You talk to your insurance company, that can make it go away. You don't even have to have that litigation. Or if you do, then honestly, you work a lot harder, and you can usually get those settled if they need to, and you can win the ones that you should win. And if you do that, everyone's going to remember you for your Game 5 and not for your Game 2.
Before I get to Jonathan, are there any questions?
I want to add something to what Carlo said. I think one of the most important reasons to go public, it's expensive, it's a hard road to travel, but when you earn $1 in a private company, it's only worth $1. If you earn $1 in a public company, it can be worth the multiple that applies to that segment, and sometimes that can go to 20 times. So there's a real reason to want to be public.
I don't know if you heard that in the back of the room, but basically you're saying going public, when you're a private company, you earn $1, it's the same as $1. On a public company, it could be $2, $3, up to $20, up to whatever the market's bearing. So that's a big advantage to being public. Thank you. Jim.
Well, just as a side note to that, private company, more money is raised on private companies, okay? Just, I don't want this to get confused as just public companies raising money. When you're private and you raise capital, a lot of my clients, I'll tell them this, let's say they say, we want to raise $20 million. Well, it all depends where you are, you know, what's your valuation, what kind of revenues you're doing, et cetera. And you may be giving away the store by raising $20 million, right? Let's say you raised $5 million of that 20. And you took that money and you hit every milestone you said you were going to do. Well, guess what happens? Your valuation goes up. So the next round of financing, the cost of capital is going to be cheaper, right? And then, it all depends what industry sector you're in, what's hot, what's not. But if you're positioned by the right banker, I might add, to be acquired, who knows what the multiples could be? Could be higher than an IPO on an acquisition. You don't know. It's about positioning. And making sense, it's all, you know, public-private. There's different ways of building evaluations.
And I think one of the themes that we see very often, which we haven't yet touched on, is that a lot of these companies come to all of us to proceed through this journey, whether it's through the S1 and then the 211 listing on the OTC or listing on NASDAQ. They do some funding, and it's, okay, now what? I'm like, well, what do you mean now what? They're like, well, my stock's not trading. I put out a press release and nothing's happening. And I think there's this misconception that if you go down this path of I did A, B, C, and you check the box, that all of a sudden there's just going to be this onslaught of liquidity and buying that comes in. And ask anybody that's gone through that process, it is not the case. Because that's when the real work starts and the heavy lifting. And there's a whole formula that we're all still trying to figure out that helps through that process. Historically, it was, well, I put out a press release and I hope somebody reads it. In today's day and age, it's a whole formula between conferences and roadshows and social media, not just the press releases. So, Jonathan, I think you can speak to some of that that's required, because it's changing daily in terms of what works and what doesn't.
Yeah, it is, and obviously it's very competitive out there. I mean, just online content or any kind of content, you know, we're not too far from Times Square, for instance. People are constantly being bombarded with different messages, and it's about reaching your right audience with the right message, and I know that probably sounds a little cliche, but that can be very hard to do, you know, with the way things are right now. And the other thing I think a lot of companies struggle with is reaching beyond, you know, the people that already know about them. And I'm pretty excited about providing a presentation tomorrow with a whole bunch of ideas and how you can reach, you know, new investors in more of a discovery process. So it's more their idea, they found you, and then they get excited on their own.
Just out of curiosity in the room, how many people have a LinkedIn account? That's impressive. Much better than last time. Any other questions? In the back. Jim, you want to take that? Yeah.
Okay, so I'll put the real fallacy today. Typical IR, I have a good investment. Okay? So it works at the company. And this bit, someone says, I'm being real honest with the whole world. Somebody says to me, hey, I think the stock for 50 cents to buck 50, 90 days, you run. You run. First of all, you're not creating a real bond. You're not creating a real market. Real markets are relative support and relative resistance. Okay? In today's environment, unless you're unlisted, it's a hell of a lot harder. I think something crazy. You know, right? It's a lot different. The bottom line is very simple. And I used to work in systems a lot. If you put out the numbers, you have the proper analysis to make it you're showing. So when a trick to the trade and the secret sauce, you gotta know who's in the game. What happens to it in a license in the game? If you're trying to show you're dealing your advice deal to an oil and gas house, who cares? This goes on. All right? You gotta know the players, eventually know the analysts who are in your industry sector. You start working with them, ball game over. Because then you have real position taking, real marketing taking, real support, so everything you do is going to be appreciated by the street. Then you hope one day that your stock is analyzed quarter by quarter by your earnings per share, right? That's when you're in big business. Make sense what I said?
You know, I actually see, this is a so,
tell if the company isn't performing, it's not going to do anything.
It's the long term, that, you know, it's a consistent effort. You have to keep doing that. So it's the momentum forward.
Any other questions? In the back?
What's the stock transfer agent do?
Great question.
That was on Miami Park.
Stock transfer agent. Stock transfer agent, our role is really to be your window to the shareholders. We keep the books and the records to issue the securities. People often say, well, when do I need a stock transfer agent? Really, it's when you're about to go public, or if you're a private company and you want to present yourself as if you are ready to take on investors, shareholders, institutional investors, and really, just take the Excel QuickBook off of your hands. The other thing is that what often people confuse, and this is an important component for those of you that are in the public world, people often confuse the roles of a broker-dealer, a transfer agent, and a clearing firm. People will call me up as a transfer agent, start yelling and screaming, saying, well, why won't you deposit my stock? I want to sell. I'm like, I'm not a broker-dealer. I can't sell. All I do is issue the shares or transfer the shares, hence the transfer agent part. You have to know which firms are doing which transactions. And I think that the takeaway from this evening and from tomorrow is really just to try to get to know the different players in the industry, again, private or public. One of the things that I always say is phenomenal about NIBA as compared to most every other conference that I go to or that we sponsor. There are some conferences that the audience is there on a very particular mission, and if you don't fit into that pigeonhole, then nobody really wants to talk to you. I find that the audience here and the attendees and the board and the presenters, everybody's here to really network and to learn and to meet new people. And that's really, really a value add that if you can surround yourself with the right people, whether it's the service providers, the attorneys, the auditors, the bankers, that's something that's going to help you, accomplish what you're setting out to do. So if there are no other questions.
One last question. Everybody knows the problem with depositing those CCQBs now. If you do a full-blown audit, PCOB, and the OCCQB, and you do the XBRL every quarter, it's expensive cost significant to do that on a quarterly basis. Do we really see the opportunity if it's still a low-price security, perhaps you're able to be deposited, or is it still the current way of doing it?
Want to take that?
I'll start, and I think we all have something to say about it. I think both of us sit on a roundtable discussion group at OTC Markets trying to address this situation. And really the question has to do with depositing low-priced securities. It's not as easy today because a lot of clearing firms are not comfortable with companies that are not on a national exchange. Penny stocks, and that's defined as any stock that's $5 or below. So many stocks fit into that category, or that are not trading on a national exchange, some clearing firms absolutely will not deposit. And I'm like a microcap person for, almost 25 years. Most of my clients fall under the category of a $75 million market cap or below. They're up and coming. They are ready to list on a national exchange.
Emerging.
They're emerging. They have so much to look forward to. That's, I keep saying it's gratifying, but that's the kind of, if you've got a company that has an opportunity to really pivot, or it's at a, what's the term I'm looking for, where, yes. When you're at that point where a company really can have significant change, it's often in that level. And we need to be banding together as service providers to figure out a way. One of the things that we've been talking about exorbitantly, but it just hasn't resolved anything quite yet, is providing a level of due diligence to the clearing firms and to the regulators so that they massage the rules a little bit. Like if the lawyers could indicate with a legal opinion the tracking of a certificate from start to the fifth owner and have all of the documentation required to write various legal opinions in one accessible folder that anyone at a clearing firm could pick up and have all of those records, it might make a difference, but it requires the collaboration of many. And I was kind of pleased to see so many law firms attending this roundtable and talking about collaborating and coming up with a way to fix the problem. So there's no real easy answer. It is going to be a challenge. It should encourage most of you to one day list on a national exchange, but that doesn't solve the problem for so many of you now that want to go public or that are public on the OTC markets. And we care about it and we're trying to address it.
I just have one quick thought on that to pick up on what Andrea just said there. I cannot tell you how many litigations get started because of this very reason. And what I always see, it's not a legal opinion from Andrea or from someone like her. The difference between a real, and yes, more expensive, but a real opinion letter that shows that real lawyers put in real time and did real work, and that's what she's talking about. That is never the kind of legal opinion letter you see at the bottom of the problems, the litigations. And that, it's the reputation, it's the game too. That's why the clearing firms don't want any penny stocks. It's because they don't see, or the reputational value there is not the Andrea style of a legal opinion letter. What they see is, I'm not going to name them, I'm sure a bunch of you do know who I'm talking about, but there are factories out there where you pay what amounts to 25 cents and you can get a legal opinion letter. They don't need to know much more than your name and your company's name and maybe the address, and you're going to get your legal opinion letter. It will be meaningless and it'll cause a litigation, and that really, you didn't spend the money on a better legal opinion letter. It leads to a litigation, it leads to bad reputation, and that is why the clearing firms don't want to be involved.
Don't get me started.
Well, I can think of no better topic than depositing stock to turn to drinks. Have a great evening, everybody.